Hi, welcome to the session on Introduction to Derivative Products. I am Srinivasa, Faculty, School of Management, Sastra Deemed University. Hedging risk is the process by which a finance manager of a firm fixes a price for a future purchase or sale of a given asset. This can be accomplished by any of the four following instruments: forward contracts, future contracts, options contracts, and swap contracts. When prices are volatile, they can either increase or decrease from their current levels. Consider the case of a company planning to borrow money 3 months from today, but interest rates would change over time. It is not certain what the interest rate might be when the company seeks to borrow. The interest rate could rise, in which it would be making a higher interest payment on the loan as compared to what it would be making if the borrowing took place today. On the other hand, if the interest rate goes down, the amount of interest would be lower than what would be if the borrowing took place today. If the interest rate moves up, the interest rate is said to move against the interest of the company, and if the interest rate moves down, it is said to move in the company's favor. The direction of movement of interest rate will have implications on hedging activities. Forward contracts. A forward contract provides the holder of the contract the right to buy or sell the underlying asset at a future time that is agreed upon at the time of entering into a contract. Typically, forward contracts are short-term contracts and non-negotiable, and the two parties that enter into the contract have to fulfill their obligations when the contract expires. Forward contracts are usually entered into by private parties and hence are called over-the-counter contracts. For example, Iyengar Bakery entered into a forward contract with the Shakti Sugars, a sugar manufacturer, on January 1st to buy sugar on March 31st at Rs 30,000 per 1000 kg. There will be no cash exchange on January 1st. However, on March 31st, Iyengar Bakery will pay Rs 30,000 irrespective of the price of sugar in the market, and Shakti Sugars will deliver 1000 kg of sugar to the bakery. This contract will be binding on both the parties and both have to honor their commitments. Futures contracts. As like forward contract, a futures contract provides the holder of the contract the right to buy or sell the underlying asset at a future time at a price that is agreed upon at the time of entering into the contract. Although the future contract is similar to a forward contract, futures contracts are negotiable, and either party to the contract has the right to transfer the contract obligation to a third party at any time before the expiry of the contract. These contracts are traded in futures exchanges. So the counterparty risk is low. Futures contracts can either be written on real assets or on financial assets. If they were written on real assets, they are called commodity futures. If they are written on financial assets, they are called financial futures. Options contract. An options contract gives the holder the right to buy or sell the underlying asset on or before the maturity date of the contract. The major difference between options contracts and forward or futures contracts is that the holder of forward or futures contracts will have to fulfill the obligation under the contract, irrespective of whether the position in the contract results in a gain or loss. However, the options contract holder has the options of not having to fulfill the obligations under the contract if the position results in a loss. An options contract is more valuable than futures contract and consequently requires an initial investment at the time of entering into the contract. Options can be traded in options exchanges, or options can be contracted between private parties, in which case they are known as over-the-counter options. For example, ITC intends to borrow ₹1 billion in 3 months in the future. Since the borrowing will be done at a later date, ITC faces interest rate risk. To hedge this risk, ITC enters into an options contract with a strike rate of 7%. This means that if the actual market interest rate is above 7%, ITC will exercise the option and borrow at 7%. If the market interest rate is below 7%, ITC will let the option expire without exercise and borrow loan at market interest rates. In order to get this option, ITC will have to pay the party with which entered into the options contract the upfront, which is known as option premium. Swap contracts. In general, forward contracts and futures contracts have short-term maturity, whereas swap contracts can have long-term maturity. Swaps are contracts wherein two parties agree to exchange future cash flows according to a mutually agreeable formula. This was used to exchange interest rates or currencies. For example, BHP, an Australian company, may want to borrow in Indian rupees to invest in India, while Tata Steel may be planning an investment in Australia that requires Australian dollars. In such case, both firms may find it convenient to borrow money in their own currencies and then swap the loans. Here, BHP will borrow Australian dollars in Australia and Tata Steel will borrow in Indian rupees in India, and then the two firms will swap the loans so that BHP will pay interest on the Indian rupee loan and Tata Steel will pay interest on the Australian dollar loan. So in this lesson video, we looked at the introductory aspects of derivative products. In the classes to come, we shall be dealing in detail about each product in terms of its specifications. Thank you.